There are moments in financial history when a seemingly ordinary headline turns out to represent something much larger, not because it immediately changes the price of gold, and not because markets react overnight, but because it quietly reveals how governments are thinking about the future. One recent development involving the United States and Ghana has prompted exactly that kind of question. At first glance, it may appear to be another story about trade, investment, or natural resources. Yet for investors who follow precious metals, reserve assets, and the broader monetary system, it may deserve a closer look. This is not a story about chasing headlines or predicting the next gold rally. It is about understanding why strategic relationships involving major gold-producing nations sometimes attract attention far beyond the mining industry. More importantly, it is about asking a question that rarely makes it into mainstream financial coverage. What are governments preparing for when they place greater strategic value on physical gold and critical resources? To be clear, this discussion is not built on conspiracy theories or dramatic predictions. The goal is not to suggest that one agreement will suddenly transform the global economy or guarantee where gold prices are headed next. Instead, it is about examining publicly available information, historical precedent, and the broader economic forces that have shaped gold's role for decades. History has shown something remarkably consistent. When confidence in the financial system becomes uncertain, governments often begin paying closer attention to assets that have preserved value across generations. In the early 1970s, the global monetary system underwent one of the most significant changes in modern history. During the global financial crisis of 2008, investors around the world reconsidered what constituted a true safe haven. In more recent years, central banks have steadily increased their gold reserves at levels not seen for decades. These events were not identical, but they shared a common theme. When uncertainty rises, the conversation around gold becomes far more important. So where does Ghana fit into this picture? Why would one of Africa's largest gold producers find itself at the center of conversations involving the United States, resource security, and long-term economic strategy? And why have some market observers connected these broader discussions to the monetary perspectives of figures like Kevin Warsh, whose views on inflation, debt, and central bank credibility continue to influence investors? These are the questions worth exploring, not with hype, but with evidence, historical context, and careful analysis. As you reflect on this, consider your own perspective. In today's environment, which asset do you trust most? Gold, silver, cash, or stocks? By the end of this discussion, you may find yourself looking at that choice from an entirely different perspective. To understand why this story has captured the attention of some investors, we first need to understand Ghana itself. When most people hear the word Ghana, they may think of West Africa, cocoa production, or a rapidly growing economy. But beyond those associations lies a country that has quietly become one of the world's most important gold producers. Year after year, Ghana ranks among Africa's leading gold-producing nations, supplying hundreds of tons of gold to international markets. That production supports not only its domestic economy but also the global supply chain relied upon by refiners, jewelry manufacturers, technology companies, central banks, and investors. This is not just a local industry, it is part of the infrastructure of the global financial system. That is why relationships involving major gold-producing countries deserve closer attention. It is important, however, to be precise. When people hear the phrase gold deal, they often imagine governments secretly transporting massive vaults of bullion across oceans or preparing for a dramatic monetary reset. In reality, international agreements are usually far more practical. They may involve investment, mining cooperation, refining capacity, supply chain resilience, trade policy, or broader economic partnerships. This distinction matters because the issue is not about sensational claims, it is about understanding incentives. Every nation holds strategic resources that others consider valuable. Some control vast energy reserves, others dominate semiconductor manufacturing, and some possess critical minerals essential for modern technology. Ghana's strategic advantage lies in one of the world's richest and most established gold industries. In today's uncertain global environment, reliable access to strategic resources has become more important than many people realize. Over the past several years, global supply chains have experienced disruptions that few economists predicted. Shipping delays, geopolitical tensions, inflationary pressures, and shifting trade relationships have forced governments to rethink long-held assumptions about economic security. For decades, efficiency was the primary objective. Today, resilience has become equally important. That shift extends beyond food, energy, and technology. It includes natural resources as well. Gold occupies a unique position because it functions simultaneously as a commodity, a financial asset, and a reserve asset. Unlike oil, gold is not consumed. Unlike industrial metals, it does not disappear through manufacturing. Nearly every ounce ever mined still exists somewhere, in vaults, central bank reserves, private portfolios, exchange-traded funds, or family heirlooms passed down through generations. This makes gold fundamentally different from almost every other commodity on Earth. Its supply grows slowly, yet demand can shift rapidly when economic confidence changes. That is one reason governments continue to pay attention to it, even in an era dominated by digital finance. Over the past decade, discussions about economic security have expanded far beyond military strength. Policymakers increasingly focus on supply chains, strategic commodities, critical minerals, and financial resilience. The objective is not necessarily to prepare for a specific crisis, but to reduce vulnerability before one emerges. That is a subtle but important difference. History shows that governments rarely wait until problems become obvious, they plan years in advance. Not because they know exactly what the future holds, but because uncertainty itself creates risk, and managing risk is one of the oldest responsibilities of any government. This brings us back to the relationship between the United States and Ghana. Rather than viewing it as a single isolated event, it may be more useful to see it as part of a broader global trend in which access to strategic resources is becoming increasingly significant in economic policy discussions. That does not automatically mean gold prices are about to surge, nor does it prove that a major monetary transformation is imminent. But it does suggest something worth watching. When governments devote more attention to strategic resources, long-term investors often begin to ask whether deeper structural changes may be forming beneath the surface. And that leads to an even larger question: if resource security is becoming more important, what might that imply about the future of the monetary system itself? To answer that, we must step back and examine the broader economic picture, and why voices like Kevin Warsh continue to matter whenever serious investors discuss inflation, debt, central banks, and confidence in the financial system. If the relationship between the United States and Ghana tells us something about strategic resources, the next question becomes even more important. What kind of economic environment makes those resources increasingly valuable? To answer that, we have to step back from gold mines and trade agreements and examine something much larger: the global monetary system. This is where Kevin Warsh often enters the conversation. Whether one agrees with all of his views or not, Warsh has consistently argued that confidence is among the most valuable assets in any financial system. As a former member of the Federal Reserve Board of Governors during the period surrounding the 2008 financial crisis, he witnessed how quickly confidence can evaporate and how difficult it is to restore once it is lost. That experience shaped much of his thinking. He has emphasized that long-term economic stability depends not only on interest rates or employment data, but on the credibility of institutions. When households, businesses, and investors believe policymakers can maintain price stability and protect purchasing power, the financial system tends to function more smoothly. When confidence weakens, even gradually, behavior begins to change, consumers adjust spending, businesses delay investment, banks tighten lending, and investors look for assets they believe can preserve value during uncertainty. This does not mean gold prices automatically surge. However, history shows that concerns about inflation, debt, or currency stability often increase interest in assets perceived as long-term stores of value. That pattern has appeared across multiple economic cycles. After the 2008 financial crisis, central banks adopted extraordinary policies, historically low interest rates and large-scale asset purchases that significantly expanded their balance sheets. Then came the pandemic, prompting unprecedented fiscal stimulus alongside further monetary support. These actions helped prevent deeper economic collapse, but they also revived long-standing debates: how much debt can governments sustain? How much monetary expansion is compatible with long-term price stability? And how is confidence in a currency maintained over decades, not just quarters? There are no simple answers. Economics is not physics, it is shaped by incentives, expectations, and human behavior. That is why experienced investors often focus less on precise predictions and more on underlying forces. One such force is government debt. Many advanced economies now carry debt levels that would have seemed extraordinary a generation ago. Debt itself is not inherently harmful. Governments borrow to finance infrastructure, respond to crises, and support growth. The challenge arises when debt expands faster than an economy's capacity to sustain it. Higher debt servicing costs, particularly in a higher rate environment, create difficult policy trade-offs, raise taxes, reduce spending, borrow more, or attempt to stimulate growth through monetary measures. Each choice carries consequences for inflation expectations, interest rates, and ultimately currency confidence. This is why conversations about gold are rarely just about gold. They are about trust in monetary policy, fiscal discipline, and institutional credibility. Gold generates no earnings, pays no dividend, and produces no cash flow. Yet across thousands of years, societies have assigned it value, not because it generates income, but because it has historically served as a reference point when confidence wavers. That does not make it a replacement for productive assets. Businesses drive innovation, stocks represent ownership, bonds generate income, and real estate underpins economic activity. Gold has traditionally played a different role. Many investors treat it less as a return-maximizing asset and more as a form of financial insurance, held not in expectation of catastrophe, but in recognition that uncertainty is a recurring feature of economic history. This brings us back to the broader question. If governments are placing greater emphasis on strategic resources, if debt levels remain historically elevated, if inflation continues to influence monetary policy, and if confidence remains the foundation of modern currencies, then perhaps the most important issue is not whether a single agreement moves gold prices tomorrow. It is whether a collection of incremental developments, resource strategies, central bank actions, shifting geopolitical relationships, signals a broader evolution in how governments approach economic resilience. History suggests that major transformations rarely begin with one dramatic event. More often, they emerge through a series of ordinary decisions that only reveal their significance when viewed together, and nowhere is that pattern more evident than in the long and complex history of gold itself. History has a remarkable way of humbling investors. Every generation believes its challenges are unprecedented. Each era introduces new technologies, financial innovations, and economic theories that promise to rewrite the old rules. Yet when markets face genuine uncertainty, investors often rediscover lessons that have echoed across centuries. Gold is one of those lessons, not because it always rises in price, and not because it is a perfect investment, but because it has repeatedly played a role when confidence in money itself becomes a central concern. To understand why governments, central banks, and long-term investors continue to pay attention to gold, we must return to one of the most pivotal dates in modern financial history, August 15, 1971. On that evening, President Richard Nixon announced that the United States would suspend the convertibility of the US dollar into gold. What was presented as a temporary measure effectively ended the Bretton Woods system, in which major currencies were linked to the dollar and the dollar was tied to gold. The world entered a new monetary era, one built almost entirely on fiat currencies, whose value rests on confidence in governments and central banks rather than direct convertibility into a physical asset. This shift transformed global finance. It granted policymakers greater flexibility to respond to recessions and crises, but it also elevated the importance of something intangible, trust. As long as households, businesses, and investors believe a currency will preserve reasonable purchasing power, the system functions. When that belief weakens, behavior changes. The 1970s illustrated this clearly. Oil shocks, geopolitical tensions, and persistent inflation eroded purchasing power across developed economies. Savings lost value, interest rates surged, and investors sought assets they believed could withstand inflation. Gold became one of them, not as a cure-all, but as an asset perceived to stand apart from government promises. Decades later, the 2008 financial crisis presented a different kind of shock. The threat was not runaway inflation but systemic collapse. Major financial institutions faltered, credit markets froze, and volatility surged. Once again, confidence stood at the center. Governments and central banks responded with emergency lending, near-zero interest rates, and large-scale asset purchases. These measures stabilized the system, yet they reinforced a powerful lesson: financial systems depend on trust, and trust can vanish more quickly than it is built. The COVID-19 pandemic delivered another historic disruption. Massive fiscal spending combined with expanded monetary support aimed to prevent economic freefall. Many economists argue these actions succeeded in averting deeper damage. But they also coincided with the return of inflation at levels unseen in decades. For households, inflation was no longer an abstract statistic, it was visible in grocery bills, fuel prices, utility costs, and housing expenses. Regardless of the exact percentage reported, families were asking a simple question: why does everything cost more than it used to? It is during such periods that gold often re-enters public discussion. Not because history guarantees it will outperform other assets, history offers no such assurance, but because monetary transitions tend to reshape investor priorities. At times investors prioritize growth, income, or liquidity. At other times, they prioritize resilience. Experienced investors rarely build portfolios around a single forecast. Instead, they prepare for multiple outcomes, recognizing that diversification is less about certainty and more about managing uncertainty. Viewed individually, developments such as rising government debt, renewed focus on strategic resources, debates over inflation, and shifting geopolitical alliances may seem unrelated. History, however, encourages a broader perspective. What if these are not isolated events, but different expressions of a common theme, governments and institutions reassessing resilience in a world where uncertainty feels less temporary and more structural? That does not mean history is repeating itself. It means history provides context, and context is often one of the most valuable assets an investor can possess. If history explains why gold has endured for thousands of years, the behavior of today's central banks shows how that legacy continues to shape modern financial strategy. While headlines tend to spotlight stock market swings, cryptocurrency volatility, or the Federal Reserve's next rate decision, another quieter trend has been unfolding in the background. Central banks around the world have continued adding gold to their reserves. This is not hidden information. Data from institutions such as the World Gold Council and the International Monetary Fund clearly documents official gold holdings and central bank purchasing activity. The real question is not whether they are buying, but why. These institutions employ highly trained economists, analysts, and risk managers. They oversee fiat currencies and manage complex financial systems. Why, then, would they continue to hold an asset that produces no yield and pays no interest? The answer lies in the distinction between return and resilience. A central bank's mandate is not to maximize profits, it is to preserve financial stability. That requires preparing for scenarios that may be unlikely but would carry significant consequences if they occurred. In that sense, central banks think less like hedge funds and more like insurers. They accumulate reserves not because they expect immediate crisis, but because uncertainty can never be fully eliminated. Gold aligns naturally with that philosophy. It carries no issuer risk, unlike sovereign bonds. It does not depend on the policy decisions of another country, unlike foreign currencies. It is not someone else's liability. It exists as a tangible reserve asset with a long monetary history. For these reasons, gold continues to sit alongside currencies and government bonds within official reserves. In recent years, many countries, particularly emerging economies, have gradually diversified their reserve portfolios by increasing gold holdings. Some seek to reduce concentration in any single asset. Others aim to strengthen domestic financial confidence. These purchases are typically incremental and methodical rather than dramatic. And that is precisely what makes them noteworthy. Major institutional shifts often unfold quietly over time, attracting limited attention until their cumulative impact becomes clear. Economic transformations rarely happen overnight. Globalization expanded over decades. Digital payments evolved gradually. Interest rates declined across multiple cycles. Gold's role in reserve management appears to be following a similar incremental path. This does not signal the abandonment of the dollar, nor does it imply an imminent collapse of fiat currencies. Such conclusions exceed the available evidence. Instead, it reflects a measured recognition that diversification enhances resilience in a complex and uncertain global environment. When viewed alongside broader developments, greater attention to strategic resources, supply chain security concerns, persistent inflation debates, elevated government debt levels, and shifting geopolitical dynamics, a consistent theme emerges. Preparation, not prediction. Resilience, not certainty. Sophisticated institutions rarely rely on a single forecast. They prepare for multiple scenarios: persistent inflation, slower growth, financial instability, or geopolitical stress. Gold becomes one component of that broader framework, not the strategy itself, but part of a diversified approach. Long-term investors often study institutional behavior for this reason. Central banks are not infallible, but their sustained actions can reveal how experienced policymakers evaluate risk over extended time horizons. Sometimes the most meaningful signals are not found in speeches or press briefings, but in steady, consistent allocation decisions made year after year. If governments are strengthening strategic resource partnerships, if central banks continue to treat gold as a meaningful reserve asset, and if monetary policy remains central to global economic debate, the takeaway is not alarm but inquiry. The more productive question is not whether gold will surge next year. It is why the institutions charged with safeguarding financial stability continue to allocate part of their reserves to an asset with no yield in an increasingly uncertain world. The answer to that question may ultimately prove more significant than any short-term movement in price. After examining Ghana's role in the global gold market, Kevin Warsh's views on monetary stability, the lessons of financial history, and the steady accumulation of gold by central banks, we arrive at the most practical question of all. What does this actually mean for someone who owns gold, or is considering it? The answer is more measured than many headlines imply. First, it helps to distinguish between investing and speculating. These terms are often used interchangeably, but they reflect very different mindsets. A speculator tends to ask, how much can this asset rise next month? A long-term investor asks, what role does this asset play in protecting my financial future? That difference in framing can shape every decision that follows. If gold is purchased solely for short-term gains, periods of volatility can feel disappointing. Its price has experienced extended stretches of sideways movement and underperformance compared to equities and other growth assets. History makes that clear. Gold is not a guaranteed path to wealth, nor is it a flawless hedge against every economic challenge. It should not replace a diversified portfolio of productive assets. Yet that is not why many experienced investors choose to hold it. For them, gold serves a distinct purpose. Consider how people think about home insurance. You do not buy insurance hoping disaster strikes. You buy it because the financial consequences of an unlikely event could be severe. If nothing happens, you are relieved. If something does happen, you are protected. Many investors view gold in a similar way, not as a bet on catastrophe, but as a recognition that uncertainty is unavoidable. Economic cycles shift. Governments and policies change. Inflation rises and falls. Markets rotate between optimism and fear. No forecaster can predict each turn with precision. In that environment, preparation often proves more durable than prediction. Imagine two investors. Michael, a 42-year-old engineer, experienced years of strong equity returns and concluded that gold had become unnecessary. He allocated all of his savings to growth assets, assuming recent performance would continue. Sarah, a 60-year-old business owner nearing retirement, also valued equities and productive investments. But she understood that her time horizon for recovery from major market declines was shorter. Rather than attempting to forecast the economy, she constructed a diversified portfolio that included a modest allocation to physical gold. Neither investor possessed superior information. Their difference lay in philosophy. Michael prioritized maximizing returns. Sarah prioritized balancing growth with resilience. In strong expansions, Michael's strategy might outperform. In turbulent periods, Sarah's diversification might provide stability. Both approaches have merit depending on objectives, time horizon, and risk tolerance. This is why financial professionals often emphasize asset allocation over market timing. The essential question is not whether gold is inherently good or bad, but whether a portfolio reflects the range of uncertainties that could unfold over decades. Discussions about developments such as the evolving relationship between the United States and Ghana matter not because they guarantee price movements, but because they signal how governments think about strategic resources and long-term resilience. These signals do not predict tomorrow's headlines. They simply indicate that major institutions continue to plan for uncertainty. Individual investors may benefit from adopting a similarly thoughtful approach. That does not require abandoning equities, bonds, or real estate. Long-term wealth creation has consistently relied on productive assets and disciplined investing. Gold, at most, is one component within a broader framework, a tool rather than a complete plan, a form of insurance rather than a promise of extraordinary gains. In the end, successful investing is not about forecasting every economic development. It is about constructing a portfolio that allows confidence regardless of which scenario unfolds. Beyond price movements and policy debates lies a principle that endures across generations. The greatest advantage is not knowing the future. It is being prepared for more than one possible future. As we reach the end of this documentary, it's worth returning to the question that brought us here in the first place. Does the USA-Ghana gold deal change everything for gold investors? The honest answer is no. One agreement, one headline, or one policy announcement rarely transforms the global financial system overnight. History doesn't move in sudden, isolated leaps. The most significant economic shifts tend to unfold gradually, through hundreds of small decisions made over many years, becoming clear only in hindsight when we connect the dots. And perhaps that is the most important takeaway from everything we've explored. This story was never just about Ghana, nor solely about the United States, nor even about Kevin Warsh. It has always been about the broader context. We've examined how gold has remained relevant across centuries of economic transformation, not because it guarantees wealth, but because it has often served as a store of value when confidence becomes uncertain. We've considered how governments think about strategic resources, why central banks continue to hold gold in their reserves, and why experienced investors often prioritize resilience over prediction. None of these insights guarantee what gold will do next month, next year, or even over the next decade. Markets are shaped by countless variables: interest rates, growth, inflation, technological change, geopolitical events, and investor psychology. No single individual can forecast all of them with precision. That is why the objective should never be to predict every market move. The objective is to build a thoughtful framework that supports sound decisions regardless of what unfolds. Successful investors understand that wealth is rarely built by reacting emotionally to headlines. It is built through discipline, perspective, and patience, by asking better questions, studying history, and recognizing that uncertainty is not something to fear but something to prepare for. Gold has endured through every major monetary system in recorded history. Empires have risen and fallen. Currencies have appeared and disappeared. Financial innovations have reshaped global markets. Yet gold has remained part of the conversation, not because it is flawless, but because confidence, trust, and resilience have always mattered. If there is one idea to carry forward, it is this: do not base investment decisions on headlines alone. Pay attention to long-term trends. Observe what institutions do, not just what they say. Study history before assuming the future will be entirely different. And above all, build a portfolio aligned with your goals, your time horizon, and your tolerance for risk. The future does not belong to those who claim perfect foresight. It belongs to those who prepare with patience, discipline, and independent thinking. If you found this analysis valuable, consider subscribing. Each week, we examine the forces shaping gold, silver, central banks, inflation, and the global economy, not through sensationalism, but through evidence, historical context, and calm analysis. Now I would like to hear from you. Do you believe the USA-Ghana gold deal signals a meaningful long-term shift, or is it simply one chapter within a much larger global story? Share your thoughts below. Your insights often inspire future discussions. Until next time, remember, markets are noisy, headlines compete for attention, and predictions constantly change. But history speaks in a quieter voice, and for those willing to listen, it often offers the clearest guidance of all. Thank you for watching. Stay informed, think independently, and I will see you in the next documentary.